Hey everybody, my name is Joe Pivarunas. I'm the founder and managing editor of Renalytix. We're a boutique media and research firm covering disruptive tech stocks for a broad audience of retail and institutional investors across the globe. Today we're going to talk about a stock called Renalytix. They're traded here in the States and also in the UK. And the title of this presentation is Has Growth Arrived? Now, before we get into that, I want to take a step back here and talk a little bit about our approach. So we have a premium subscription offering, and as part of that, we have a tech stock report and also a tech stock catalog that has about 420 stocks. And each one of those stocks we've given a very simple rating to. So we either love it, that means we actually own it in our own portfolio. We like it, which means we think others might consider owning it, or we avoid it, in which we say others should probably consider avoiding it. Now, since we all have different tolerances for risk, this is simply meant as an indicator, as a way for us to employ our methodology, which is a living document where, as we go through time, we learn more about our experiences investing and we add rules and revise them. So, for example, we came up with this size rule probably a year ago or so, and we said we don't invest in firms with less than $1 billion market cap. Now, there's a good reason for that, which mimics what you see index providers do. So companies like MSCI will say, well, we're not going to cover for a particular index stocks with a market cap of less than $1 billion, and they'll put a cutoff in place. And what that allows us to do is really reduce risk. So small companies are more risky. Now that means, of course, there's more upside, but we're happy to sacrifice upside in exchange for lower risk. So we've classified these size buckets here. This is actually leveraging some of the work done by ARK Invest. In the most risky bucket, you can see small companies with a market cap between 1 billion and 2 billion. And then you go to medium, and then there's large, 10 billion to 100 billion, which is our sweet spot. And then hopefully they graduate to mega caps. And along the bottom here, you can see our target percentage weighting that we're trying to achieve for our own portfolio. Now, let's get back to talking about Renalytix. This is a firm that we last looked at coming up on several years ago, and we listed in our report, we listed the company as a like, particularly noting the strong leadership. But as we said here, we'd like to see some revenues coming in before we consider a position. Now, this was before we instituted our size rule. So here's the thought process about Renalytix, all right? So it's in our report as a like, but we have two rules that say we don't invest in companies that are less than $1 billion market cap, and we don't invest pre-revenue. Now, we consider revenue to be meaningful at $10 million per annum or more. So Renalytix hasn't hit that mark, and they're also quite small. So they're a $250 million market cap company. Now, one way to look at this is you can potentially invest now and capture 300% upside before they get to the $1 billion mark, or you can wait until they've achieved traction and then invest and reduce some of the possible downside risk. There's still some uncertainty around this company, and that's what we want to talk a little bit about today. So if you don't know much about the firm, I'll include a link to our past research piece that covers the bull thesis. Very exciting company. So they're doing something that nobody else is doing. They have this blood draw they do, and then they extract data from it, and they apply some machine learning, and they give a risk score for kidney disease. It's all very exciting stuff. And there's certainly a lot of promise in the firm. And one of the things that we found quite compelling was the company's leader. And frankly, it was quite tempting back then when we looked at the firm to make an exception to our rule. But once you start making exceptions to rules, it's useless. And what we're looking for now is consistency. So if somebody reads that report and sees that we like a firm that breaks a number of our rules, that doesn't make sense. So we're more interested in being consistent. Now, this gentleman here had a previous success story in exosome diagnostics. So he raised venture capital, and then he took the company public, and it was acquired for $575 million. Actually, to be honest, I'm not sure if that was a publicly traded company when it was acquired, but it doesn't matter. He showed a great ROI to his investors, and now he's leading Renalytix. So certainly we like to see proven entrepreneurs leading firms. Now, revenues are just starting to trickle in for this company. So last quarter, they brought in $800,000 in revenues. It's better late than never, but we noted that in a 2018 investor deck, they had been promising revenues for 2019 of $6 million. So we don't like to see companies that break their promises. Now, there's probably any number of good reasons why revenues have taken so long to arrive, but if you look at last quarter and the quarter prior to that, at $950 a pop, that means they sold about 1,200 tests. That's not very many, and that's because presumably because they haven't received FDA authorization. We'll talk about that in a second. Now, if this test, as they say, results in savings of up to $1.1 billion over 5 years per 100,000 patients with kidney disease, then the test offering should be selling itself. And what they're doing is working with Mount Sinai and then the US government for the VA health system. And look at the size of these TAMs. So for Mount Sinai, they've been working with them for 4 years. That's a TAM of about $306 million based on that $950 test. And then they have the sales team, 4 regional sales managers and 12 account executives. That's a decent sized team focusing only on the VA. And that's a $1.3 billion TAM. So the company says that potentially their total addressable market is around $12 billion. These are some very big numbers. Now, why haven't we started seeing the revenues come in if there's all this sales team building up and all this, optimistic forecast of revenues? Well, here's a chart that shows the actuals. So for Q1 2022 and Q2 2022, you can see in green there, that's what they've actually been able to bring in. And then black here, we've plotted what 40% quarterly growth looks like. So that means by the end of 2023, they would have achieved meaningful revenues. The idea is that we would expect once the FDA approval happens for growth to be a lot stronger than that. But again, we don't know. Now they're expecting that approval to happen this year. They say here, these are the milestones that they're looking for. And, they spend a decent amount of time talking about, all the other expansion plans. So multiple hospital partnerships. It's like just Sinai alone or just the VA alone is a big enough opportunity. Capture that, right? So we're more interested in capturing what they already have in their pocket. So once they get this approval and they're optimistically expecting FDA approval this year, then we would expect everything to take off. Now, that's regulatory risk, which the company can't control. It hasn't happened yet. They haven't received the approval. We don't know what the approval will look like. We don't know what the FDA will say. That's an uncertainty. And you may say, well, the founder is a tenured executive who understands the process and who's able to, accurately predict when things will happen. Well, this is the FDA. It's an external entity and you can't control that. Now, some people will argue that now is the time to buy shares so that when that approval happens, that you can enjoy the gains. That will undoubtedly happen if there's an FDA approval, but that's not how we look at things. We want to avoid risk and volatility. So if the firm gets FDA approval and then they start selling tests, as soon as they get to the $10 million per year mark, that's when we're interested in taking another look. And we may then resume liking the company. Until then, we think it ought to be avoided because of that regulatory uncertainty. Now, everybody needs to make their own choice, but they've been in regulatory purgatory now since August of 2020. And this de novo approval that they're looking for is expected again this year, but this uncertainty creates a lot of volatility and certainly has depressed the share price. They've been raising some money to make sure that they could survive until they could start selling enough tests to pay the bills. Now, what an avoid means, and the reason that we publish this piece and this video is for our premium subscribers, because we can't just take a stock that we have listed as a like, change it to an avoid without an explanation. So until they have this approval until there are meaningful revenues which demonstrate traction, we're avoiding the stock. That doesn't mean we think the stock price will drop. That doesn't mean we don't think it will go up significantly when there's FDA approval. It just means that we're not interested in speculating on that. We're not interested in that risk. We're happy to sacrifice some upside in exchange for more certainty. That doesn't mean you should avoid it too. If you have a higher tolerance for risk, this looks like a pretty interesting play, and a lot of our readers do. But we are risk-averse tech investors, and we try to minimize risk. That means that we're going to change this in our catalog and report to an avoid until they receive regulatory approval and until they clear $10 million US a year in tests, which isn't very much. Now, when you look at simple valuation ratio, this is something else that we consider. We don't invest in companies with a ratio over 40. This is a rule. That number 40 is arbitrary. It's not so important that the number 40, it's important that you have a number. And some of our subscribers say, well, I use 20 or 30 or whatnot. And what you do is you take, very simple, market cap, divide that by annualized revenues. And we use annualized so that it's more responsive. That's simply last quarter times 4. And that gives you a ratio. We don't invest in firms with a ratio higher than 40. So there's another reason that we wouldn't invest in this company right now. We would wait until they have meaningful revenues and the ratio is, let's say, 40 or below. And these days, a ratio of 40 is quite high since tech stocks have been correcting. So just to conclude, this company claims a $12 billion total addressable market. There's nothing like their product offering on the market right now. They appear to be on the cusp of very strong revenue growth when that approval happens, and will possibly revisit the firm once meaningful revenue growth happens and possibly move that back from an avoid to a like. We're more interested in having consistency in what we do than we are on speculating about what might happen to companies. Even though this looks very promising, it's still just a story, and there's still a great deal of uncertainty. So we wouldn't invest in any firm below $1 billion market cap. So even if that share price goes through the roof, if they have successful approval, then that's where our valuation ratio comes into play. We say, well, it needs to have a decent valuation before we consider investing in it. And then we also need to consider that this is quite niche. Kidney disease is fairly niche. And whenever you have a disease like diabetes or kidney disease, and a company is just targeting a single disease, we find that it's more optimal that the let's say the value proposition crosses more than just a single disease. But nonetheless, it's still an interesting company with a lot of potential. It's quite exciting, and a lot of investors might find this as a let's say company that's flying under the radar with a lot of potential. So we're going to go ahead and wrap that up. Please put your comments in the comment section of the video, questions, feedback, etc. Make sure you subscribe to our channel, and thank you so much for taking the time to watch this video today.